Exit rules are there to help you exit at the most optimal point while you are in a winning trade. You don't want to exit too soon and leave too much money on the table, but you also don't want to stay in a trade too long once it starts pulling back or running out of momentum while you keep telling yourself that price is just in a small pullback and you should just know, or you just feel that it's going to bounce back and go your way again. No, you need to have a tested exit strategy. Exit, close that trade, pocket your money, and then enter again with the next setup. Setups happen in the market all the time. You are not in a lack environment. You just have to learn how to play in the market and protect your capital at the same time. And exit rules 100% help you do that. It is always, always better to have an exit plan than to rely on getting stopped out of your trade. The only exception to that is when you've already scaled out of your trade and you just have a small runner and part of your tested plan is to exit when that small trailing stop of your runner is hit. I want to show you some ways that are popular and some ways that I have personally used in strategies to form exit rules. And this list is in your handbook so that those of you who have the course, you can keep notes and come back to when you're tweaking somebody else's strategy or when you're forming your own. Some popular trade exit signals are, exiting at a determined number of pips, saying I take 50 pips. Once the market has moved 50 pips, I'm exiting at that point. A market structure break. When market breaks a certain structure, you exit or at least scale out. Trading a support and resistance level. Fib management, where the fib shows you to, when to close down a trade, when to exit. Set ATR. That ATR is the average true range. And it says, hey, in a whatever time frame you're on, let's say we're on the daily time frame, it says, hey, for this pair, each day, this candles or this pair usually moves 80 pips. And so you can know, like in a day, the ATR is 80 pips. And so you might say, well, as soon as I hit that 80 pips, I'm exiting that trade. You might have an indicator that is really, really good as an exit signal and that gets you out of the trade before price, just absolutely reverses, against your trading bias. It could be a moving average that once price crosses the moving average in the opposite direction, you exit. Or if it even bounces off, a moving average, you exit. There's a couple of rules you can write around that. A large market move. Sometimes people feel like, hey, when we have these large institutional candles or large market moves, that there's exhaustion after and they can exit out of that. And then there are people that believe the opposite, that a large market move would create a whole nother set of exit signals that they want to stay in for that. And you could also have a trailing stop that says, hey, I'm entering this trade, and if price drops 20 pips or 30 pips or 15 pips or whatever your range is, that the trade automatically closed. So there's a lot of these popular exit signals, that can be set up in a strategy. So you see, there's so many different moving parts that make it very, very unique to not only your personality, but your comfort level in your trade as well. There are a lot of popular stop loss management. This is your exit signals here, your stop loss management here. You can also have a stop loss, a determined number of pips from the entry, meaning if price reverses 20 pips or 50 pips from my entry, I'm going to close that trade. Again, you can use the ATR level for your stop loss where, hey, the, price on the daily moves 80 pips a day. So I'm going to set my stop loss at 1x the ATR. So we know it's 80 pips. I'm going to make my stop loss 80 pips. Or you could say a half of ATR. So 40 pips, or you could say 1.5 ATR. It just depends on your pair, what you're trading, and your comfort level and win loss and trade management in that. Again, a trailing stop can also be not only, for your exit, like we talked about over here, but it can also be, your absolute stop loss management, because it essentially is your stop loss, but it can be used as your exit point. again, fib level management, that as your fib levels are on the screen, if price begins to fall, if price is going up like this and you say, okay, so as price, passes this fib level, we move the stop loss here. And as price passes this level, we move it here. And as price passes this level, we move it here, or you can be one level behind where you can say, as price passes this level, if price is traveling up and you have a couple of levels, that when price passes this level right here, the second level, that you bring the stop loss up to this level. And that when price passes this level, you bring the stop loss to this level where you're one level behind. So that's a fib level management possibility and market structure that just, again, as price is moving in the market and moving up, that at the last structure, when price is here, your stop loss is here. When, price is here, your stop loss is here. When price is here, you move in your stop loss here. That you're moving it up according to structure so that price hopefully is only doing a retracement that is less than 100% of that move. And so, you're not getting stopped out below structure. That price, again, just like this had this impulse move up, and it does pull back, but it never pulled back to the last structure. So that's a very popular stop loss management. So there's a lot of different ways, not only with stop loss, but also exit signals that just make for a very unique strategy. And it can also, any one of these can absolutely affect how much money goes in your pocket, how little you lose, your win-loss ratio. If your stop losses are too tight, you're getting stopped out and you're losing, you can not get out soon enough and lose too many pips, and not have tested out your pair. And so these are important. And there are a lot of ways to manage these and a lot of options that you can have that are really powerful to your trading strategy. The first way of possibly managing your exit from a live trade that you're in that I want to go over is simply just exiting at a determined number of pips. And what that means is that when you enter a trade, you probably have a set number for the stop loss and you have a set number for your exit. And I can't remember exactly what it was, but it was one of our very first strategies that John and I had. And I want to say it was a 50 pip strategy exit. So we took profit at 50 pips, and the stop loss, I can't remember, was either 20 or 30 pips, but it was every single trade that was placed. You had your entry point, just like I have set up here. That was why I just picked the 50 pip. Every single trade was exactly the same. Now on this one, I just have a 10 pip stop loss here and a risk reward ratio of 5. However, we actually live traded, a set number of pips for the stop loss and a set number of pips for the exit before. And it was a very successful strategy and just one that was really, really simple. You just had to kind of dial in your entry signals, but the exit, your take profits, and your stop loss was already, consistent and dialed in for you. And so in this case, this first example is a determined number of pips. We've already said 50 pips here. And so if we were entered into this trade just as it is, we would either manually exit right here at the 50 pip mark, or we would set our limit order to close the trade at this exact amount, at this exact price point. And what that would look like is just like, okay, so price is moving in our direction and it goes down, and price is going to close automatically somewhere around here. And you're never going to be able to pick tops and bottoms. So yes, price, moved a little bit further from that. But if you can execute the same exact trade over and over and over again, you have unlimited ability to provide for yourself, your family, and to create a life that you desire. So really, you don't have to pick tops and bottoms. You just have to find that edge in the market and be consistent. And this is one exit strategy that is common and is used a lot of times, and it's just exiting at a certain number of pips. Now we're going to look at a market structure break exit signal. And if you are in this live trade right here, you basically have a market structure break here, right here. This was a previous swing, and you have market structure break here. This was a previous swing, and then you have a structure break here. And for our example, we're going to just look at this market structure break here, and we're going to say, hey, if we're in this entry right here, we would take profit here at this first break, and you could also choose that structure break as well. However, we're just going to say for our example that you would have a take profit here, and for this exit strategy, we're just going to say, hey, we're putting our exit at this latest market swing right here. We have it in our trading plan, we have it in our rules, and so now we know that we are in this live trade. We have looked at previous market structure breaks, and what we have decided is this is our exit point. Right now, we have just entered this trade. We have our stop loss. We know that we are looking for a 47 pip run if we are going to get the full amount of this trade that we have entered. And now we're watching to see what's going to happen. And price absolutely hits our trade. And if we've already set up our previous exit point, price automatically closes out, or we close out, at that point. And so a structure break, for using that for exit signals, it just looks at previous price points that the market has reacted to in the past. And I have said this previously in this course, that while I looked, if you look right here where the actual break is, it's a little bit lower on both of these points. And instead of putting my line right on that exact price point, I usually put it just a little bit above, just because you don't ever know exactly where price is going to bounce, or if it's going to bounce there a little bit previous to that, just a little bit after, you don't know. And so I usually, if I'm ever looking at market structure breaks, put it a little bit higher or a little bit lower, just depending on what your trade bias is that time, instead of exactly right on that price point. Because just remember, you're looking at a range of prices versus an exact point in the market. Okay, let's look at using now support and resistance levels in the market as our trade exit signals. So first, obviously, to have support and resistance being used as our exit signals, we're just going to assume that we already have support and resistance levels marked. And so I'm just going to quickly mark up this chart. And so we're just going to mark what we see. We kind of see a level here, a swing in the market, and so I'm catching this level here right at the bounces here. So we're going to grab those, make this just a little bit wider, and we're also picking up this bounce right here. Okay, we're going to take, and we see a level that's actually coming across right here. And so what I'm looking at here is I see a bounce here, a bounce here. You see where price didn't really react to it here. It starts reacting again to these levels, and then you have some recent price action bouncing there. We also see a low in the market here, and we're going to grab this reaction here, these reactions here, here, and here. And then I see another zone right here that I'm going to also grab. And while you didn't have a lot of reaction here that was consistent, you had a minor, definitely a minor level where price wasn't really respecting that here. Let's see if we had any respect back here, just out of curiosity. Not a lot right there, but over here you do have some reactions here of a minor level. So we've marked that. We've marked those levels of support and resistance, and in using support and resistance as an exit signal, it might look something like if you had your entry here. If you were trading zones, if you had your entry here, you would have your trade that would run either through the first zone and see if price bounced on that zone. It did bounce back up and then blew through that zone. And so you could have your exit set on, a certain level of support and resistance. This right here, again, was a minor zone. So maybe you didn't choose to exit on that zone. If this was your entry, you could have chosen to ride it out, but you decided, hey, this was a much stronger zone in the market. And yes, technically you had lows coming down here, but you chose to look at this last order block where price had this push and came back and bounced already once here. And so you said, no, this is my exit level. And so regardless that price continued to push down, you could also say, no, as soon as price hits that level of, support or resistance, just depending on which your trade bias is at the time, you are going to choose to either automatically or manually close your trade as soon as price hits that level of support or resistance. So that's another really common way of managing your trade exit signal. I've already gone over this several times in this course. You know I love me some fib management, and fibs are great when it comes to managing your trade exits. Now, one of the ways here, we can just look at drawing your fib from a swing, and we've got a golden zone that is right here. Let me change that over here to this golden zone. And so let's just go back in time and take our entry right here in the golden zone. And with that here, saying that now we have taken our entry, and let's just say through our testing, we have discovered that we are most profitable at take profit 1 when we are on the 1 hour charts on the euro dollar. And so we are looking right now at a 1 to 3 risk to reward, a 38 pip stop loss, and 122 pip trade. And so we're saying, hey, this is our entry. And soon as price hits this point right here at the 23.6 of the fib, that is our exit, because we've measured the swing here. We look for price to retrace up in the golden zone somewhere between the 50 and the 618, and then we look for price to reject there, and we've kind of got already where we see price has rejected at that zone several times. So we're seeing some strong evidence of price having a hard time pushing above, plus we've got some fabulous manipulation going on. So we got a lot of people establishing their stop losses below here, and so you gotta love that. You can either see the liquidity or be the liquidity. And so in this right here, we've taken our entry, and so now we are going to ride price action down until it hits our exit signal, and our trade is either automatically or manually closed. And so you can take really any zone or any level that a fib gives you and use that as your exit signal. That's another really popular way to close out your trades. All right, let's check out what using your ATR, which is your average true range, which is an indicator that measures what the average movement of a certain pair is over specific time frames of a specific period of time, like what that average candle or that average time period movement is, how many pips you can expect it to move during that time frame. So using the set ATR point, let's look at that, the indicator. And I know I've gone over this before in sections of the course, but if you find your average true range indicator and you add it to your screen, you just select it there, it's going to throw it to the bottom here. And what I usually do if I have the ATR and if I have a strategy that I'm running with the ATR, I click here on this indicator more button, these 3 dots right here, and I click on move to an existing pane above. Immediately it's going to throw it up here with the candlesticks. Now I don't care anything about this actual line graph of the ATR. What I want is the actual number. I want the number of pips. And so if I come in here to the gear bar here, because now your ATR settings are up here at the top, and if I click on that gear box, one, I'm going to use yellow just because I run a really dark background, and so I like the numbers to be really bright and visible. And what I'm going to do is when I click on the line, I did change it to yellow because it also makes the numbers turn yellow, but I am going to make the opacity of the graph completely clear because I don't want to see it overlaid on my candles. And I'm just going to say, okay, now the ATR is on my chart up here, and you see ATR 14 RMA. And now if you look right here, you see that number in yellow. Remember, I changed it to yellow, and you can see it kind of moving as I'm rolling over certain candles. Like, watch that number change. And right now it's going between 15 and 18. That's what you're seeing. And so on the different candles, 14 periods above this particular candle right here that I'm on, for 14 periods, the average was 21. You can see right there. So see that 214? You remember you're going to discard the 4, but it was 21 pips is the average of each candle for 14 candles ahead of the candle that I'm over right now. So it gives you the average of these past 14 candles. Now, I actually like to run a little bit of a higher length than that. So usually, and it does also depend on the time frame that I'm trading. But if I'm trading higher time frames, I do tend to like further averages when I'm using the ATR. Okay, so right now we're going to say that we have a entry, and so that we're entering into a sell right here. We've got this candle closed, we've got our confirmation, our entry signal. I'm just going to move this over real quick, and we've got our entry signal. And so now all we're trying to do is just establish where our stop loss is, where our exit is, and get all of our trade management in place. And so if we take the candle prior to our entry, we're going to say that our entry is right here on after the close of this red candle. So it'll put our entry right here. And so if we go, I usually go to the candle that closed right before it, and you see my crosshair is right over the previous candle. And if you look up here to the top, pay attention to that yellow number right there. I'm over the candle prior to the candle before my entry, and it says that the average true range on this time frame is 15. So each candle moves about 15 pips on this 1 hour time frame. You see I'm on the 1 hour time frame. Now, if I really wanted, I could come up here to the daily and say, okay, well, how much does it move in a day? And I could go to the previous candle, and you see it been moving as an average of 98 pips in a day. But on the 1 hour here, when we have our entry, we have from the candle before, you have that it moves an average of 15 pips. And let's say for our strategy, we have found that we are the most profitable when we run 2x, 2 times the ATR. And so we're going to come here to our inputs, and we know that 1 time ATR is 15 and 2 times ATR is going to be 30. And so we're going to take our, and let's just say we're doing, 1-to-1 risk to reward, and we're going to run 30 pips. That's a 30 pip trade close, and we're going to actually bring our stop loss down because I just can't even give y'all an example. I just don't ever run 1-to-1. I thought I could do it. I can't. So what we're going to do is 1 to 1.5 here. is what we're running. So we have now set up our trade. We know where our exit is, and so we're just running off the ATR. And so we know, hey, like we looked at the daily on this pair, we can usually see about a 96 pip move on average per day. And we see per hour that we can expect about a 15 to 18 pip movement per hour. This is powerful, powerful information, y'all. I mean, yes, it does fluctuate, and sometimes you'll get, a 60 pip move, but sometimes those averages are really, really a lot of information that you can tell each hour how many pips this pair moves. So the Euro USD for the last 33 candles or last 33 hours has moved an average of 16 pips per hour. And so with that, we're going to say, well, in our direction to our bias, which is sales right now, we're going to come in and we're going to claim at least 2 of those hours going to the downside. And so we're going to place our trade. And so right now we're ready to place our trade. We're in our trade. We have our exit at a specific set point, which was 2 times the ATR. So we have our, at 30 pips is our set point. And so now we go through our trade and the trade automatically closes out at that 30 pips. And if we can repeat that over and over and over again, you are a master trader. And so I wouldn't say that the ATR is necessarily a really, really popular, way, but it is out there. And so for people that really dig into ways to really craft stronger exits, looking into a currency pair's ATR is a really strong and promising way to look at managing when to close your trade. Now, I've put an indicator strategy that I have used in the past and will actually probably release sometime in the future. And so I've just thrown it up on the screen, and we're going to look at now what it might look like to have an indicator be your exit signal of when to close your trade. Now, in this particular example, what we have is we have all of our signals that are a yes. We have our hull here that has said, yes, you're in sales, awesome. We have the choppiness here that is like, absolutely, you're good to go. We have the check-in here where your price has dropped down below your signal line, calling for sales. And we have the jerk that has just dropped below the 0 line, and it is also calling for sales. So you are, yes, all the way down across the board. Now, I usually have in some type of structure or some other confirmation. However, with this, we're just going by the indicators. And so we are now entered into a sell. All right, we're excited about that. Now, the thing with that is we don't necessarily know where the exit is going to happen because we're waiting for the indicator to tell us when to exit. Now, you usually in a strategy like this, you would have several indicators, for confluence, or that you use, or maybe use all price action strategy and just have one indicator that you have found is freaking amazing at getting you out of trades, before price reverses or before it has a deeper retracement. And so whatever, you're going to usually have one indicator or one signal that tells you when to close your trade. And in this particular strategy, we use this indicator right here. This is the indicator that tells us when to close. And so right now you see this red line dropped below our signal line. Our signal line is the white line. And so now when we see the red line cross back above the signal line, that is our signal to exit. So this, in this particular strategy, is our exit signal. So we're going to be watching that indicator. Until then, we're just letting our trade play out, okay? And so let's go forward. And right now, we are still solidly in our trade. You see prices dropping. And so we're seeing, okay, we did have a spike up. We did not hit our stop loss. We are good to go. Still in our trade. Price is still dropping. Wow, this is awesome. Now we're watching our indicator. We see that price has gone on down because remember, we didn't really know where to set our our graphic kind of showing us, what our risk to reward was. We know our probability from our back testing because we are smart traders and we test everything. And so we do have a unit coming up teaching you all about how to back test like a freaking boss and how to dial all this information I'm giving you in. But for now, we're following this. We're still in our trade, like no emotion. We're not having to worry about it. We know because we've tested out that this indicator is badass at getting us out of trades at the perfect time. So we're just riding it out. Right now, we're still good to go up, and we just had that cross. And so what that means is price did, if you watch, have a retracement, and this indicator is saying, hey, you might want to exit because we have tested it out and seen that we should exit where this indicator shows. So that was a cool 52 pips just with watching, some indicators that we have tested out. You're just seeing where their signals lead you. Everything was still calling for sells. However, our exit indicator gave us that signal to close the trade. So we did, and now we move on to looking for our next entry. And so that's what it would look like if you were using indicators as your signal of when to close your trade. Let's check out what using a moving average as a dynamic form of when to close your trade and what that might look like. So let's assume that we have our entry signal, whatever your strategy has proven out, whatever that is. And so we're going to be taking a short position. Here's where the candle closed right here. And so we're going to put our stop loss right above this candle. And now we don't know where our exit is going to be because in this case, we're going to use the 50 moving average. Let me go back over this. I just have the 20, 50, and the 200 simple moving averages up. They're just, red, yellow, and green. And the yellow is our 50 moving average. And in this particular strategy, that moving average is going to serve as our stop loss. And so this is the line, this yellow line here, this is the moving average that we're going to be keeping our eyes on. And so we're just going to, be kind of tracking it right here. We're showing, hey, we are in a trade, but we don't exactly know where our exit is because again, our exit signal is when price breaks back to the other side because we're going to the downside. When price retests and crosses back across this 50 moving average, you see right now, if I move everything off, price has closed. You know what? Let me give you this candle. Maybe you can see it better. Price has closed below this 50 moving average. And so we're going to be going forward. Like I said, that when price now closes back to the other side, that's when we're going to exit our trade. All right, we've got our entry right here. Now let's go forward in time and just track that moving average. All right, so you can see here's the 50 moving average right here. It's so far right now, the moving averages are fanned out very, very nicely and price isn't anywhere near bouncing off that 50 moving average. And so far, we are 103 pips into our trade. We are on the 1 hour time frame, so that is freaking amazing. And so far, we're still riding it out. Now, you probably already wanted to have taken profit, during that time so that you want to secure the bag. Remember, always protect your capital because even though price is here at 179 pips, if you don't take profit right now, here's where your 50 moving averages and price could come all the way back and bounce off that 50 moving average in a matter of 15 seconds. And you would go from having 179 pips to it stopping out at that stop loss, and you could end up with 20 pips. And sometimes that happens. So that's why we're smart traders and we do scale out of our trades. But right now, price hasn't given us any indication that it's about to jump off that 50 MA. So we're going to keep going. still going. Price is still plummeting, but look at this moving average, how it's catching up with price. You see a lot of the momentum has slowed down, and so we're watching. Now you can also set up automatically in TradingView for your trade to close when it hits or crosses that moving average. So you can set this up. It's a great strategy that you can use if you were at work or if you can't sit and manage your trades, that you go, yeah, it's a set it and forget it type of strategy. Like, I've got my entries dialed in and I know that I trust that 50 moving average to get me out of my trades. And so right now, you know, we've had a possible 266 pips so far. And so that's really, really freaking good. All right. And we're still going. Oh, okay. So did you see this right here? Let me come right back, because what just happened was price just bounced off that 50 moving average. Now it depends on what your rule is. Now your rule might be like, hey, if price touches the 50 moving average, I am out. Because right now what you see is we had a possible 291 pips or 290 pips probably, but price is already retraced. If you look at where that closed out, price is already retraced. Instead of 290 pips, 218 pips. So you have price already pulling back, you know, a good 70 pips here, which is fine. I mean, again, it depends on your strategy of what you find profitable. At some point, you got to make decisions of when to exit, and you want to be consistent as to what calls your exit. You want to lose less and you want to hold on to your capital. So in this case, yes, price did touch the 50 moving average, but it did not close beyond it. It did not close beyond that 50 moving average. So your rule may be that, yes, if price even crosses it at all, it automatically closes, or your rule may be that it closes beyond it, it goes. I have no idea what's fixing to happen, so let's just see. Okay, so price again touched it, but did not close beyond the 50 moving average. So if your rule was that price had to close the other side of the 50 moving average, you're still in. You know, now I would be looking very closely at that trade at this point, even before this next touch. You can see this 20 moving average kind of coming off. You can watch what price action is doing. It's failed to break structure. It's failed to put any new lower lows in. You know, but you do still have lower highs being printed, so you would have to be choosing. But if you continue to go on, you still have not had, yes you do. So price right here closed beyond the 50 moving average. And so what was this trade? Here was your close right here. This was your trade. And so you actually had this, what was it? You had 248 pip run, and there was no emotion. There was really no management, and it would depend on your rules as to when you got out. But truth is, between this right here, this first bounce and where this closed, it's only a 39 pip, you know, that you grab, but still 39 pips is 39 pips. But sometimes you would lose more than you would win. You just have to test that out and see what your rules are. But that's what maybe following a moving average would look like. And just because I, you know, picked the 50 right here for using it as my stop loss doesn't mean you have to do that. Again, that was just for this example. You want to test out anything, again, go to the next unit, and we are going to dive into back testing, which is awesome. So let's move on to the next one. This is actually one of my favorite trading elements, and it's looking at large market movements or large institutional candles. And there's a couple ways that I've seen this used in managing exits. And in one way, say you entered, you know, a trade right here, as you see, you know, market starting to put in higher higher lows and starting to move up, and this is a reversal point or a point of support that you see in the market, and so you're looking for price to reverse. And so say you enter, right here on this candle. Well, I have seen large market movements traded in such a way where you would ride this trade up, or let me grab this, you would ride this trade all the way up until, if you saw these big institutional candles like this, that soon as that candle closed, that you would exit, because from their strategy perspective, that when the market has a lot of momentum with that they're not looking for tops and bottoms, and they're not looking for all of the movements, but that a lot of times momentum or exhaustion, enters into the market. And so they look for these big institutional candles and then the exhaustion that follows. And so any of the retracement, any of the pullback right there, that they would use that to exit. Now, another really cool way to use these large institutional candles is that whenever you have the large institutional candle, then you look for price to reverse. And so just like in this case right here, here is our institutional candle right here, and price comes down and price does reverse. And you look for price to come back up to the halfway point on the institutional candle. And then no matter what is happening, you close or exit your trade. And you use that, and you can hear this and see this folded into different supply and demand type of strategies, different imbalance trading. Like I said, even one of my elements in my very current strategy that I love has to do with imbalance. That is actually a confluence that I look for when placing my own trades, are imbalances. And a lot of times with your imbalances, price comes back to fill in this imbalance. And so a lot of times people look for the reversal, look for price to begin looking for a change of character, a change of bias. And then probably in this case, as they're looking for that, you're looking for price to fail to put in new lower lows. And so right around this area, especially this second bounce right here, you would be looking for an entry for a long here. And so you would come right up to this, halfway point of this large institutional candle here. And so you would have grabbed 93 pips, just with that trade, if you use the institutional candles for your exits. In this case right here, look, right, we have this large candle right here. And so we go, okay, so price comes up and then price begins to reverse. It fails to go any higher. And so price comes right here. And you might not would have had a very, just depending on where your entry is, a very long trade. If you could have gotten on a lower time frame, you could have gotten in probably just right up here at this structure break. So you could have even entered somewhere. Here we go. Entered somewhere in here, and you're looking for price to come to the halfway point of this institutional candle. And if you look right here, price absolutely did come down, come back up, come down, and it literally hit right at half point of that institutional candle and bounced all the way back up here before then reversing. And so if you used that as your exit right here, as soon as price hit there, that would be your exit. And with that particular strategy, you are needing to dial in your entry, as well. Here, right here, you have a large institutional candle. Price comes up, price actually on a lower time frame, you would have had this candle, and you probably would have entered somewhere right here, and this wick right here of this very next candle on a lower time frame would have hit the halfway point of that candle. But let's just say we didn't take that. This is our halfway point. And if you would have gotten in on a lower time frame when price begins to, break structure here and print in new lower highs, let's say that you got in somewhere right around here, you would have had at least a 25 pip run, before you would have closed out at the halfway point. And so using the institutional candles again as a place to close out, you have a large candle right here with your halfway point, somewhere, although I would have definitely seen this, this wick right here and moved it up and counted that definitely as a time to close. But you see price came up, reversed, and came right back down to this to mitigate this imbalance here of this institutional candle. And so again, it's just another exit, way that I have seen when you're using large momentum candles or institution candles or imbalances in the market to manage when you close your trade. Here's another one right here. If you just had this large bullish candle right here, and you see price pushed up, and again on a lower time frame, remember we learned that there's a lot happening here. Price didn't just go straight up. There was a lot of zigzag, but price came right back down, to the halfway mark in this candle right here. And so you could have ridden, let's see how many pips that is, depending on where your entry was, but a good 20 or so pips. And that again isn't bad. If you remember, the ATR on this pair is only 15 to 18 pips per hour. And so, grabbing 20 pips isn't bad at all, and so again, looking at these institutional candles, you have one right here. Where's the midpoint of that candle? Right here. And you have price came up, depending on where your entry is on that lower time frame, you could have grabbed some pips. Price came right back down to that midpoint of that institutional candle. And so a lot of times when people are in trades and they see the institution, they look at that as like, hey, there was this momentum, and so I got a little bit of a boost from that, so I'm going to exit. And then you have a lot of people that look for price then to reverse and come back to retest or to mitigate those areas of imbalance or those institutional candles. They just look at that price comes back to that, and so they use that as their exit point. Pretty cool stuff. And all of the imbalance in institutional candles, like I said, I highly recommend you pay attention to those. That is one of the elements in my own strategy that I absolutely love. And so now let's check out the trailing stop. Very, very common, very, very profitable, and a lot of traders will use this as a way to consistently exit their trades. Now, there are several ways to run a trailing stop loss, and there are other places in this course where I dive further into stop loss and, some of the ways to, some of the options that people use in that. So let's just look at a couple right now. One way of doing a trailing stop loss is an X number of pips trailing stop loss. And so what that means is that if you have a trade that you enter, say we just open a trade right here, we put our stop loss right above structure, and we're running this trade and we're thinking that it's gonna, we're gonna come down here to the structure break, and so we're looking for a, wow, that's a 1 to 21, so that's a pretty big risk to reward. However, really awesome if you grab that. But what we're gonna say is like, hey, we're going to enter this trade. However, the way we're going to run it is that if at any point price retraces within, I'm only willing for price to go back, say 30 pips. Well, let's just draw ourselves a line that is 30 pips long right here, real quick. And so 30.5, so that's good. So this is like a measuring stick. There's a million tools you can use for this. And so you can just kind of see, as long as price doesn't move back, doesn't pull back more than 30 pips, we're good. So if you had a trailing stop loss here, then once price pushed to this wick right here is what you see. Once price pushed here, then when it began to retrace back, which it came back to your entry point, once price retraced that 30 pips, your stop loss or your exit would have absolutely been triggered, and so that trade would have been closed. And so that's the hard part, is you go, oh, how many pips am I willing to lose on a trailing stop loss? You don't want it to strangle your trade, because as you see right here, it moved back 30 pips. You were 50 pips in profit here. Yeah, you were 50 pips in profit, and price came all the way back 52 pips probably. But then it came on down and dropped down, and that entire trade, had you stayed in it, would have been 80 pips. And so are you willing to lose, 55 pips and let your trailing stop loss be 55 pips. That's a harder trailing stop for me, just depending on what time frame. If I'm on a really high time frame, the daily or the weekly, that's not as unheard of, especially if you're on, a pair that moves. I mean, it just got some momentum, during the day and is moving a couple hundred pips, or if you're trading gold or some of these higher volatility, pairs that's not that big a deal. Matter of fact, you can't have a stop loss any tighter than that. But you have to be willing to go, I had 50 pips right there and price came all the way back. But you don't know. I mean, as far as price was here, just kind of came down and could keep moving, without ever, going any further down. I mean, you have no idea truly where price is going to go, even though sometimes you can make statistical or look at probabilities of setups that you have studied and you have seen in the market. And so that's pretty cool. But when you're doing a trailing stop loss with X number of pips, it is basically saying, hey, if price retraces more than whatever number of pips you're comfortable with, I exit the trade. And you can do that automatically, or you can do that manually. Setting up a trailing stop loss is very, very easy on every platform. I've never seen a platform that doesn't make that really, really easy, because that's such a common way. Now, another way to measure a trailing stop loss is to manually move it just using market structure, just using price structure. So if you just look at saying, we entered a long position, let's say we did really good. We got in right here at the close of this candle and we went ahead and put our stop loss right here and we're moving up. And so right now, let's go ahead and put it at structure. I wasn't thinking. So we're putting our stop loss at structure here. And so as price moves up, we move our stop loss here. And then as price continues to move up, we move our stop loss as price moves. So now our stop loss as price comes up here, now our stop loss moves here. And so if price now, from our entry, it came up, retraced, came up and it retraced, but if it came up and failed to put in a new higher high and instead dropped below here, well, then not only is it our stop loss, but it's also our exit point. So a trailing stop used as an exit signal, is not always the best way, but you can say no, my trailing stop is structure. And so therefore, not only is it my stop loss, is also my exit signal, because I've tested it out and I know that anytime price breaks structure, that's my signal to hop out. And you've just got to study at what level. Is it minor structure? Is it major structure? Is it swings in the market? It just depends on how long you're staying, in your trades. But something like that, again, you just move your stop loss up as price continues to push up, then you would move your stop loss here, and you would get stopped out right here. You would get stopped out when you move your stop loss here and price came right here, and then you would have lost that 86 pips. That was an 86 pip drop, but your stop loss might have been moved up to this structure right here as price was pushing up. And so if that's the case, price pushed up to this peak right here and it dropped right here into this structure, 54 pips. Your stop loss could have been at this structure right here at the let me zoom in for you a little bit right here, at the wicks of these couple of candles, and then when price dropped, you automatically closed out your trade. Well, that was only a drop of 27 pips. However, 27 pips is nothing on a retracement. I mean, look here, you've got a retracement of 41 pips right here, and price kept on going. And so you don't want to strangle any of your trades. You want to test it out, though. You want to find out that when you exit a trade, how far does it usually go? When you enter a trade, how far does it usually go? And so you want an idea. You don't want to just pull it out of the air. You don't want to just pull it into, some other trader does this, or you heard this, or even if you learn a strategy from a trader, test out different ways of exiting. You don't, again, ever want to try to pick tops and bottoms. You want to protect your capital. You don't want to leave any more money on the table than you have to. Be a smart trader and test this out. But managing exit signals is really cool, and there's so many ways of doing that can really put a lot of extra money in your pocket. Now let's cover these popular stop loss management. Now we've already kind of talked about some of these. I just did. They're gonna overlap. Stop loss is when a trade goes against your bias. So you are live in a trade and you have said, yes, I'm going bearish, and price goes bullish. Or you say, yes, I'm placing a buy and price goes bye-bye for sure. I am plummeting here into sells. And so the stop loss keeps you from losing your money. You, again, don't want stop losses too tight, but you don't want them so much that you can't, emotionally, mentally, or financially afford how much price retraces. And you do that through testing and through knowing your trade setup and what the probabilities are of how far your trade might run from the entries and the different setups that you have. So in looking at this, let's look at the first one. We kind of already know what it's going to look like, but a determined number of pips from your entry. So let's just say that you were taking a short position right here, and that I used this of the very first example starting this, a 30 pip stop loss, and let's just say in this case, that we let price run until some other signal gives us our time to close the trade. But we just know every single trade that we place has a 30 pip stop loss, and so we have 30 pips across the board, every single trade, no matter where we enter. You enter right here, great, you have a 30 pip stop loss. You think that the market's going to continue up from here, fabulous. Guess what? You've got a 30 pip stop loss that you're running right here. So let me pull this in. 30 pip stop loss. No matter what, even if you get stopped out, it's a 30 pip stop loss. And so a lot of times if you have a determined number of pips from entry, that is your stop loss. It's X amount. The same thing with the ATR. I took it off, but I'll pull it up again real quick. ATR is your average true range. And now the way I do it again is I come over here. The ATR, you don't have to. If you just look right here, I'm hovering over different candles. And if you look when I hover over the candles, this red number right here changes. And if you see right here, it's ranging anywhere from 15 to 24, these numbers, because remember, you're going to discard the last number. So that's really right now 14.0 pips is that number that you're seeing. Sorry, I'm having to go kind of off to the side a little bit because if I hover over it, it'll bring the settings up. Now what I usually do, I showed it earlier, is I move this to the existing pane above. I come to my gear because now the info line is up here, and I make that opacity 0% because I don't want to see it graphed out, and because I also like to see it in yellow. It helps me to differentiate the numbers there. So I've got now this the ATR reading is yellow, and I'm going to change my settings. I've said again that I like mine a little bit higher, so I'm going to run 33 on my ATR. And so now you see any candle that you run over, you're seeing this number right here, this ATR number change. And remember, like that number right there is 21.1 pips. You're going to discard this last digit, and this is your ones and this is your tens place. And so what it's saying is, for this candle that I'm actually hovering over, that my crosshair is on right now, the average pip movement for 33 candles from this candle forward to the left has been 18.2 pips. So because I'm on the 1 hour time frame, each candle has an average of 18.2 pips. And again, there's a whole lot of information and really cool stuff that can be done with the ATR. And so a lot of times you can let the ATR choose your stop loss level. And usually for the ATR, I and I didn't come up with this level, but I do find that it works. It was actually somebody that I studied indicators under, or definitely was into what he was teaching and sharing. He's freaking amazing. But he came up with the 1.5 ATR. So you take whatever that is, you know, like right there, if you look up in the top left-hand corner of the ATR, it's on 20. And so you would make your stop loss 30. So 1.5 of whatever the ATR is. And that actually works really well. I have had on the higher time frames, some of, you know, my ATRs being, some of my stop losses based on ATR being 2x the ATR. But you just have to test that out and see what kind of setup, what kind of length of trades that you're running. But that's how you use the ATR to use your stop loss. You're either going to say 1x the ATR, you know, so 20 pips in this case, or 1.5, which would be 30 pips in this case, or you know, double, which would be 40 pips, just going off that reading up there in the top left hand corner. And again, if this was your entry, you would just go, or the way I do it is I go, the previous candle close is the candle that I hover over to get the valid ATR. And again, if you look up right here at this yellow number, if I hover over this candle that previously closed on, you know, before this entry that we would have gotten stopped out on, you see a 23.4 ATR there. And so you could take, and just depending on whether you run a 1x, a 1.5, or a 2x ATR level, you just place your stop loss for that. And so you could always know what it is, no emotion, you've tested it out. And so that's a way that I've seen a lot of people that use the ATR even know about it, you know, manage their stop losses that way. We talked about the trailing stop, not only, you know, as an exit, but also as, you know, a stop loss. And we kind of mentioned that because they kind of go hand in hand. And that's just where, let me delete this off. And that's just where you're maybe using structure, that when you see these retracements, that you're using the structure as your stop loss. So if this was your stop loss, then when new lower highs print, you know, you're moving your stop loss down so that if price, you know, ever comes back and retraces back and breaks that structure, that you are stopped out of your trade. And there is a difference between, you know, knowing that that is your exit signal because you've tested it out and you go, yeah, this is great, and so I'm using a trailing stop of structure, and that being your stop loss. Because if that's your stop loss, that means you have a different exit signal. So your exit signal might be that, well, if price retraces 30 pips, I'm out. Or your exit signal might be an indicator, but your stop loss may trail at structure or structure breaks, you know, or any type. I mean, different people do different things. Any failure in the market. So you would, again, as price traces down here and tracks, you know, with this strong push that it's got right here, you would be moving your stop losses to these levels, you know, that I'm kind of where I'm moving this line, you know, so your stop loss might be here, it would be here, you know, it just depends on what your rules are, you know, as to how far you would move it, and if price, you know, if your stop loss was right here at structure, then yes, soon as it retraced right here, your trade would have gotten stopped out if your exit signal didn't already close your trade. So again, that one wasn't so different. You know, we've covered that in a couple of ways, and I think I even cover that pretty good in the stop loss section here in this unit. One of my other favorites is the fib level management. I talked about it a while ago, but if we were just to draw a fib here, and let me just draw that fib. And if we took our entry here at the golden zone, and so say we were triggered into our trade right here when price tapped the 50 right here, and so we are in, well, in the beginning, you know, my stop loss is somewhere between the 88.2 and the 76.4, just depending on where my entry is. Now, if my entry is over here at the 61.8 or above, my stop loss is 100% at the 88.20. But if my entry, like in this case, where it literally just kisses this 50% right here, I don't put my stop loss way up here at my stop loss line. You know, I might would put my stop loss at the 61.8 or the 76 here, just because my entry level is further down. But what I do once price tracks down, you know, at take profit 1, I move my stop loss, you know, right here to break even. Soon as it hits take profit 1. Now for some people that would be too soon, you know, or at minimum, like say my stop loss started here, because right here I enter at the 50% that I'm always tracking 2 behind. So I use sometimes the fib levels just to jump my stop loss down. So let's say my entry was right here, my stop loss is 2 levels behind. And so as I come down to take profit 1, I maybe would move my stop loss here instead of to break even, you know, not quite to break even. And then when price comes down here to take profit 2, I would drop my stop loss down to break even. Now I track 1 behind. So as soon as my price hits take profit 2 right here, I actually drop my stop loss to take profit 1. And once price hits take profit 3, I drop my stop loss to take profit 2. I mean, that's just, I only track 1 fib level behind if I'm trading fibs. And like I said, fibs are just so excellent, you know, for managing multiple areas of your trade, emotionless, and just kind of letting you know exactly at this price point, like this is where your stop loss is. Like you don't even have to look, like you just type in this number, like where's your stop loss? Oh, right here at 1.03651. That's my stop loss. You know exactly where it is, you know, as soon as price hits take profit 3. If you're running 4 take profits, you know, soon as price hits this take profit 4, you know, I'm absolutely dropping my stop loss to take profit 3. So using fib levels, you know, for your stop loss is also very common. You can see people doing that. And I sort of covered this, you know, a while ago. Also at the next example of using market structure as a trailing stop loss, where if this was your original stop loss and you're just looking at where market structure breaks and where market structure is formed, you know, to kind of come down. And again, when we talked about it before, it was as a trailing stop, but sometimes while it also is a trailing stop, it's just saying, no, I use market structure as my stop loss. Now you also may want to find when you have some of these larger institutional candles, like right here, like that is a pretty large retracement area. So you may want to look at also previous structure breaks, like where a structure was broken here as a possible stop loss point as well, versus peaks and valleys and swings of market formation of lower lows or lower highs or higher lows, just depending on which way it's going, you know, as to what you want to use. But market structure is that way. And again, trailing stop, you know, can use market structure, but it can also trail just X number of pips. So there's several ways for stop loss management. Sometimes exit signals can be stop loss, and sometimes your stop loss can be exit signals, but you want to have a clear trading plan that they are 2 different things. It's again, okay if you test it out and you're just like, yeah, this is my exit signal and it's awesome. That's great, but you want to have tested that and know. And so with this, again, just kind of touching on all of these different types of signals, and I hope that that helps you. Anytime you enter a trade, you need to know how to exit. And anytime either you build a strategy or you have somebody else's strategy, you need to know how to exit. And most people don't really flesh that out. And I've given you a lot of options that when somebody just says, hey, put a stop loss on there, and you go, okay, you know, here's several ways to put a stop loss. You know, stop losses, again, can be done through moving averages and indicators, just as well as they can be done through structure, ATR levels, or just a standard number of pips. And you now have the tools for building a really powerful strategy. All you have to do is take these puzzle pieces that I've put on the table and put them together in a way that fits you.